marketplace can set interest rates much better than the Federal Reserve, than just a bunch of old professors who know nothing about how the real economy works. And that is the major problem that we have. They should just get out of the interest rate control operating system and just say, let the market set interest rates, because that's the only way that you're going to know what the real market forces are deciding. So right now, the Federal Reserve could be keeping interest rates much too high as far as we know.
It seems like they've dropped rates from 5.25 down to about 2, 300 basis point drop in official rates. And yet if you look at a 30-year mortgage, it's about the same as it was before they started this interest rate cutting cycle. It was about 6.4, now it's about 6.5. So at least in terms of creating available and cheap credit, the market's pricing in a different kind of risk and is completely ignoring what the FOMC has done.
Exactly. That the Federal Reserve can only control short-term rates but not long-term rates.
Okay. I'm just trying to get my mind around being in a 30-year inflationary cycle and continuing to see interest rates in theory, and correct me if I'm wrong here, if we see a 30-year inflationary cycle, can you assume that interest rates at some point follow to the upside? If that's the case, then how do you accommodate intermediate or even short-term bonds to be long?
30 years is a long time.
Right.
A lot of things can happen in 30 years. And you can have a period of 3 or 4 years of disinflation in the secular period of inflation. So you can have this deflationary or disinflationary period, which is what I foresee. And I don't know how long it's going to last, and that's why I use technical analysis. And technical analysis has enabled us to catch most important market bottoms and market tops within 1 or 2 days. And only technicals can do that, not fundamentals, and not guessing about the future. I always have a scenario, and I say, okay, here's my scenario. But the timing can only come from technical analysis. And right now, it tells me that we're going to be in a period of credit implosion. And that is naturally disinflationary and deflationary. Mm-hmm. Now, then we have to say, okay, what will happen when banks start failing all over the place? What is the only alternative that Washington has? It is to reflate the system. Okay, right now they're not concerned yet. Here Paulson from the Treasury keeps on saying, we're not going to backstop Fannie Mae and Freddie Mac. Everybody knows that they're insolvent. The former Fed president said they're both insolvent. Everybody knows that. And here the Treasury says, no, we're not going to help them out. That's totally ridiculous, because probably within a week or two, they're going to do that. So when worse comes to worse, when they finally recognize how bad things are, they're going to have to bail out the system and reflate. And that is the time when this disinflationary period stops, and then you get into the reflationary period. And we will see that on the technical indicators that we use. We will see exactly when that transition has been made, just as we caught it in October of 2002. The headline was, Great Opportunities Ahead, Reflation. And that's when everything changed and when all the markets turned around. It was a great period for 5 years to participate. In early 2007, they said, that's it. 2007 is going to go down in history, similar to 1929. And I even took the time and wrote a book. There's no money in writing books, as you know, but it was called Prelude to Meltdown, because I said this is going to go down in economic history as an extremely important year. And right now we see it. This is not just a normal recession. This is not just a normal credit problem that we have. This is something much more important. And we have to recognize that. So we're going to have, just out of necessity, a long-term period of devaluation of currency worldwide, not just the U.S. dollar. But inside that period, you're going to have these huge deflationary pressures exerting their power from time to time. And I think there's a period like that immediately ahead. Mm-hmm, mm-hmm. Then, of course, that will necessitate actions by the government next year, et cetera, and then you get this attempt to reflate out of it. And many of these reflation efforts have failed, as we saw in Japan. In Japan, in those 14 years of disinflation, they actually had several attempts for a new bull market, and people got caught up in it, and they were buying banks, et cetera, And then a year and a half later, back into the bear market, back into recession, etc.
I just want to say, Bert, I've enjoyed your book, Prelude to Meltdown, and encourage all of our listeners to order a copy. It's $15 well spent.
Well, thank you very much, David. You know, there's a website, meltdownbook.com, where people can get more information on the book and order it.
And secondly, I'll just repeat that, meltdownbook.com. It's about $15 and definitely worth every penny. I would also suggest for those of you who like technical analysis, those of you who are listening, his newsletter, the Wellington Letter, goes back decades. It goes back decades. This is a letter that Don and I have been familiar with for a long, long time. Obviously, Don a lot longer than I was. In fact, Bert, you and Don were giving speeches on the same platform going back 25, 30 years, and you were still writing the letter back then, if I'm not mistaken.
Yes, the Wellington Letter is now in its 31st year, and yes, Don and I have known each other for about that same period of time, and I've always appreciated his views and highly respected him, and I think we did a couple of seminars together.
Well, we look forward to that in the future as well, and would encourage our listeners to both look at the Wellington Letter at dohmancapital.com, DOHMEN, capital CAPITAL.com, or go to meltdownbook.com and look for Prelude to Meltdown.
Once again, you've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany, and our guest today, Bert Dohman.
Thank you very much, gentlemen.
Well, we look forward to that in the future as well, and would encourage our listeners to both look at the Wellington Letter at dohmancapital.com, DOHMEN, capital CAPITAL.com, or go to meltdownbook.com and look for Prelude to Meltdown.
Once again, you've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany, and our guest today, Bert Dohman. Join us at McAlvany.com, that's McAlvany.com, or call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.